Good morning, good evening, a very good afternoon, and a very warm welcome to you wherever you may be in the world. Welcome to the 2021 Richard Musgrave Lecture, which is presented to you this evening by CES-IFO and the International Institute of Public Finance, IIPF, and sponsored by Hannover Re, a new sponsor, and we're delighted to have them on board. My name is Marcus John Henry Brown, and it will be my job to guide us through the evening and make sure that all of the pixels come in the right order and that our speakers stay on time. Welcome to the 13th Richard Musgrave Lecture, since it was awarded for the first time in 2009. If you were with us for the first virtual Richard Musgrave Lecture in December, then a very warm welcome back. It's lovely to see you. A very warm welcome to you if this is your first time virtually with us. We would have loved to have welcomed you here in Munich in person, but that sadly still isn't possible. Nevertheless, we have a fantastic 90 minutes or so set up for you, with guests joining us from Harvard, Washington, and three separate self-isolation studios here in Munich. You'll be able to ask questions of our guests too by using the Slido website. It's very easy to use. Just follow the URL that you can now see on your screen and ask as many questions as you like. We'll try and answer as many of them as we can during the Q&A section. So that's the housekeeping. Here to kick off the 2021 Richard Musgrave Lecture proper with his welcoming address is the President of CES-IFO and the IIPF, Clemens Fuest.
Thank you very much.
Clemens, can you hear me?
I can hear you, yes, and I hope you can hear me.
Excellent. Welcome back. Over to you, sir.
Thank you very much, Marcus. It's a pleasure to be here. Good evening to all of you. In particular, a very warm welcome to Mihir and Victoria, to all colleagues from the faculty. A very warm welcome also to all CES-IFO and IIPF members, to friends of IFO and CES-IFO. A very warm welcome to all of you. Now, it's with great pleasure, really, that I welcome you to the 13th, as Marcus just said, the 13th Richard Musgrave Lecture, and already the second in this virtual format. This year, the lecture will be delivered by Professor Mihir Desai, who is both a professor of finance at Harvard Business School and a professor of law at Harvard Law School. His lecture tonight will be on myths and mysteries of the corporate income tax. Mihir, thank you very much for accepting the invitation to be this year's Richard Musgrave visiting professor and for giving this lecture tonight, which is part of it. It's an honor, really, that you are joining us this evening. It's a big honor for us. We would, of course, as Marcus just said, have liked to welcome you here in Munich, but that's not possible for obvious reasons. We still hope we will be able to reschedule your visit to Munich in the not too distant future. You see, we are not letting you off the hook so easily. Now, there are many distinguished guests present tonight, participating from their homes and offices, and I would like to welcome some of them personally. In particular, Gerald Segler, Chief Investment Officer, Managing Director, and Head of Investment at Hannover Re, our sponsor this evening. Furthermore, let me welcome Victoria Perry, IIPF Vice President, and our law data tonight. Florian Engelmeyer, the Dean of our faculty, and of course, Hans-Werner Sinn, the founder of this lecture series. Very warm welcome to all of you. Let me also welcome all the participants of the CES-IFO Area Conference on Public Economics, which is organized by last year's Musgrave lecturer, Klaus Kreiner, who is also the area director. The conference takes place from today until Friday. Let me briefly remind you of the history of this lecture and the selection procedure. The lecture series was launched 13 years ago by the IIPF and the CES-IFO group in Munich to honor Richard Musgrave. He brought European ideas on public finance to the US and established really public finance as a discipline in the Anglo-Saxon world. Many of us still remember his visits and talks here in Munich. He had close links to the Center for Economic Studies, to the Econ faculty in Munich, and also to the IFO Institute. Richard also wrote the first CES IFO working paper published in December 1991. Both Richard and his wife, Peggy, have visited Munich, have visited CES frequently. And today, one of IFO's two main lecture halls is named Peggy and Richard Musgrave Hall. And every time I enter this room, I see them before my eyes and remember them discussing and presenting work at IFO, and that's always a pleasure. Now, how about the procedure, the selection procedure for the prize? The Richard Musgrave Visiting Professor is chosen each year by the president and vice presidents of the IIPF and the president of CES IFO. The candidates should be distinguished scholars in the field of public finance and must have made groundbreaking contributions to this field. The nomination committee for this year's prize convened in December 2019, a different time then. The committee members for this year's Richard Musgrave Professor included Catherine Kaff and Wojciech Kopczuk as IIPF vice presidents, and myself in dual capacity as IIPF president and CES IFO president. I think I still only had one vote, but anyway. Now, there is, of course, a shortlisting and voting procedure, but it was easy for us to agree on Mihir as this year's Musgrave Professor. His research focuses on the design of taxation in open economy settings, the behavior of multinational companies, and the links between corporate governance and taxation. His work is groundbreaking. It has been published in the best academic journals. It is cited widely, not just in academia, but also in the general media, and it has also influenced economic policy. Most importantly, his ideas are highly original and inspire others to develop new research ideas. Victoria Perry, who will deliver the laudation, will tell us more about Mihir's many contributions to the field. Victoria is Deputy Director in the Fiscal Affairs Department of the IMF. She joined the IMF in 1993 and has provided technical advice in tax policy and revenue administration to numerous countries. In fact, if you were an expert on vaccines, I would be delighted if you could deliver some and give us some advice on doing that. But let's not talk about that tonight. Victoria is also IIPF Vice President, and partly in that function she's here tonight, but of course also as our laudator. So thank you very much, Victoria, for taking over this role and doing this laudation. Now, before we move on to the laudation, let me highlight an advantage of the online format. Everyone in the audience from anywhere in the world can interact with us and ask questions through the website Slido. To participate, please enter the code #CESIFO on the website. I hope that will work. Let me finally express my sincere gratitude to our new sponsor, Hannover Re. Their support is much appreciated. Thank you very much. And over again to you, Marcus.
Thank you very much, Clemens. So it is, as Clemens has just pointed out, time for laudation. I've got so much that I could tell you about Victoria Perry. Clemens has just pointed out some of it, but what I would like to say is that since joining the IMF in 1993, Victoria has provided technical advice in tax policy and revenue administration to numerous countries in all of their regions. In 2002 to 2008, she served as a division chief for revenue administration. From 2008 until 2016, June of 2016, she was division chief of tax policy. She's also written books. She's a co-author of the book, The Modern VAT, and the co-author of the recent book, Corporate Income Taxes Under Pressure, both published by the IMF. Prior to joining the IMF, Victoria was the Deputy Director of the Harvard University International Tax Program, teaching comparative income taxation, value-added taxation, and providing technical assistance in revenue policy through the Harvard Institute for International Development. Ms. Perry previously practiced tax law with the Boston law firm Wilmer Hale. She is past president of the National Tax Association, is also a past president of the American Tax Policy Institute, past chair of the Value Added Tax Committee of the American Bar Association section of taxation, and serves on the board of the International Institute of Public Finance. She received her JD from the Harvard Law School and a BA from Yale University in economics and philosophy. Ladies and gentlemen, here with the laudation, Victoria Perry.
Thank you, Marcus and Clemens. I am honored to give this laudation for Mihir Desai. Mihir's work spans finance, corporate governance, and the impact of corporate income taxation. His rigorous academic studies are anchored firmly in data and in policy relevance. This has led him to the provision of congressional testimony on many occasions. Mihir never ignores, and indeed revels in, practical aspects of policy matters. His approach is diametrically and usefully opposed to what has been sometimes unfairly lampooned as the economist's tax code, taxation in a single unnamed country that has some labor, some capital, and one tax rate, ta. Today, I will touch on just a few examples of Mihir's wide-ranging and important insights. Mihir's article with Austin Goolsbee, Investment, Overhang, and Tax Policy, has been referred to as a classic, and it provides a classic example both of Mihir's careful and exhaustive empirical work and of his skepticism regarding received wisdom. The authors address two main questions in regard to the sharp decline in corporate investment in the early 2000s. First, was the investment bubble of the 1990s correlated, as was broadly believed, with the sharp decline in investment in the first years of the next decade, the overhang of the title? And second, why the major tax cuts enacted in 2002-03 did not, as intended, restore investment levels closer to normal. Using data segregated at each of the firm, asset type, and industry sector levels, the authors find that there was in fact very little correlation between the 1990 burst of investment and the decline shortly thereafter. And they also find that the dividend tax cut of 2002 had essentially no impact on marginal investment incentives, hence giving support to the new view of dividend taxation. Corporate governance issues underlie another strand of Mihir's research, and again embody a healthy skepticism. One observer noted that Mihir, quote, comes at corporate tax issues from the standpoint of one who expects the worst from corporate managers, unquote. While this is a bit of an exaggeration, Mihir has indeed been much concerned with agency problems in corporate management. A noteworthy example is found in Corporate Tax Avoidance and Firm Value, written with Damika Dharmapala. The authors conclude that the traditional view that corporate tax avoidance transfers resources to corporate shareholders is incomplete at best. Utilizing a data set covering over 800 firms and introducing book tax income gaps to proxy for tax avoidance activity, they find differences in existence of gain to shareholders dependent upon corporate management and agency problems underlying shareholder-manager relationships. One of Mihir's major themes is the taxation of multinational enterprises and possible reforms to the global tax architecture. No subject could be more timely or relevant today, given the current debate on the proper tax treatment and allocation of international profits. Mihir's explorations in this area, frequently conducted with Jim Hines, are again grounded in detailed empirical analysis, and again, frequently produce findings contradictory to then received wisdom. They cover such questions, just to cite a few, as, is deferral of U.S. tax on foreign source income an inefficient subsidy to foreign investment? Answer, no. Does investment in foreign operations displace jobs in the U.S.? Again, no. Foreign activity is found to be a complement rather than a substitute. Why has the use of international joint ventures declined in favor of directly integrated global operations? Hint, the tax reform of 1986 played a role. I could go on, as Mihir has explored many such questions. My pick for most interesting, though, is Mihir's development with Jim Hines of the concept of capital ownership neutrality as the foundation for assessing the taxation of multinational activity and foreign investment. The concept of capital ownership neutrality is contrasted with the standard normative benchmarks of capital export neutrality and capital import neutrality. Capital ownership neutrality ensures that the identities of capital owners are unaffected by tax rate differences, thus permitting the market to efficiently allocate ownership rights. The key insight here is the focus on that potential distortion as more important from a welfare perspective than the global equalization of the returns to capital. Before I close, I must note that Mihir is a Renaissance person. He is an award-winning teacher at both the Harvard Business School and the Harvard Law School. Not easy audiences to please. And it is easy to see why when one reads his 2017 book, The Wisdom of Finance, Discovering Humanity in the World of Risk and Return. Mihir uses anecdotes from history, philosophy, and literature to illustrate the workings of insurance, asset valuation, optionality, and risk. We see the contrast in approaches to risk and uncertainty as the respective heroines of Pride and Prejudice and Phineas Finn weigh marriage proposals. Aristotle's analysis of the various sorts of friendship and love illustrate, surprisingly effectively, the capital asset pricing model. The book serves to introduce these topics to non-specialists, but also perhaps as an inspiration to practitioners of finance. Mihir, congratulations on your receipt of this year's Richard Musgrave Award. I look forward eagerly to hearing your lecture.
Many thanks, Victoria. That was a fantastic laudatio. We've now reached the part of the evening which is unfortunately almost impossible to do virtually. But I know that Clemens is going to give it his best shot. It worked pretty well in December, so let's see how it goes this time. So I'll hand back to the president of CECIFO and the IIPF, Professor Fust, who is joined now by Mihir Desai of Harvard University, the recipient of the Richard Musgrave Visiting Professorship 2021.
Thank you very much, Marcus. Now, indeed, this is difficult because we are approaching the handover Mihir of the prize certificate. We have discussed acquiring a 3D printer for that earlier, but we are not there yet. So all I can do at this stage is to show you the well-deserved prize certificate. I think Victoria, in a very convincing way, pointed out why you are here tonight and why you received this prize tonight. I may add very humbly that I've assisted many presentations, and I'm not at all surprised many presentations you gave in the past at conferences mostly, and I'm not at all surprised that you win teaching prizes, because it's indeed one doesn't necessarily have to agree to every result or whatever, or every method, but it has never been boring or uninteresting to listen to you. So I think that's a specificity of your work, and that's really great. Now, all I can do at this stage is show you the certificate. It looks like this, and I will read this to you. No, I get the side wrong. I have to keep it here in front of my face. Now, I'll read it to you. The IIPF CECIFO Richard Musgrave Visiting Professorship 2021 is awarded jointly by these institutions to Professor Mihir Desai, who will deliver the Richard Musgrave Lecture on Myths and Mysteries of the Corporate Income Tax, Munich, 24th of March 2021. So my congratulations again, Mihir, and we will send this to you, and it will be with you, this enormously important certificate, as quickly as possible. So congratulations, Mihir. It's a pleasure, and I'm really looking forward to what you will tell us tonight.
I'm so That is very kind. Thank you very much. My God, what a wonderful response. This is absolutely overwhelming, Clemens, and all the folks at SESIFO, and Vicky for that remarkable laudation. I really am deeply grateful. And I have to say that, before this event began, there was some footage of Munich from a drone, and it made me all the more, I should say, well, both a little sad that I'm not there, but also looking forward to celebrating over there in person with you, hopefully soon. It's just a great privilege and a great honor to have been recognized in this way. And Clemens and Vicky in particular, I'm deeply grateful for all of that and for your very, very kind words.
Thank you very much, Mihir. We are really looking forward to your visit, but now we're looking forward as much to your lecture. Thank you. And over to you again, Marcus, for the lecture.
Thank you very much, Clemens. And from me, a huge congratulations, Mihir. It is now time for the Richard Musgrave lecture. And a quick reminder from me that you can ask questions throughout the lecture using the Slido tool. We'll collate them and Clemens will bring them in during the Q&A session after the lecture. So I've got quite a lot of text to get through now because Mihir is a very, very, very clever person. So here we go. Mihir Desai is the Mizuho Financial Group Professor of Finance at Harvard Business School and Professor of Law at Harvard Law School. He received his PhD in political economy from Harvard University, his MBA as a Baker Scholar from Harvard Business School, and a bachelor's degree in history and economics from Brown University. In 1994, he was the Fulbright Scholar to India. Professor Desai areas of expertise include finance and tax policy. He is a research associate in the National Bureau of Economic Research's Public Economics and Finance programs and served as the co-director of NBER's India program. His research has been published by leading academic journals and cited by the popular press, and has served as the foundation for his several testimonies to the Senate Finance Committee and the House Ways and Means Committee. His research has emphasized the design of taxation in open economy settings, the behavior of multinational firms, and the links between corporate governance and taxation. Mihir has taught extensively, and as Clemens just pointed out, he is an award-winning teacher at Harvard Business School and at Harvard University. He has taught finance and international finance at Harvard Business School, tax law, tax policy at Harvard Law School, and entrepreneurship to Harvard undergraduates. Professor Desai has also created an online finance course through the HBX platform titled Leading Finance, and is co-host of After Hours podcast on the HBR network. His books include Wisdom of Finance, Discovering Humanity in the World of Risk and Return, and How Finance Works, the HBR Guide to Thinking Smart About Numbers. It is my absolute pleasure to hand over to Mihir with his 2021 Richard Musgrave lecture, Myths and Mysteries of Corporate Income Tax.
I'm really delighted to be here with all of you delivering the Richard Musgrave lecture. I confess it's both a deep honor and privilege to have been selected to give a lecture named after someone who I admire so much. And I want to thank SESIFO and IIPF and of course Clemens and Vicky very much. I have a whole bunch of slides, so I'm going to just dive right on in. And the title of the talk is The Myths and Mysteries of the Corporate Income Tax. And in short, what I have in mind here is rather than try to present you with one idea, I want to try to present you with a whole bunch of ideas that have been bubbling up in my mind about the corporate income tax and what's happened over the last 2 decades. And specifically, the debate about the corporate income tax has migrated from academia into the political arena and, of course, the public square. In that process, unfortunately, I think, several myths have come to dominate the debate about the corporate income tax, and they've dominated both politically, publicly, and academically. And I think those myths are both not grounded in empirical reality, but also are quite unfortunate because they've given rise to policy moves and a variety of things that are actually quite destructive. I don't want this talk to be entirely destructive. I think there are myths out there, but there are also mysteries, which is the other problem with these myths is they've preoccupied us at a time when there are actually really deep, interesting mysteries that we have been neglecting. So I wanted to try to take you through what I think those myths and mysteries are of the corporate income tax at this point in time. Of course, this emphasis on myths and mysteries brought me back to so much of the work that I enjoyed revisiting by Musgrave. And I began, as I recommend to you, to begin with Hans Werner Sinn's really wonderful essay about Musgrave. And of course, this is the first time I came across this quote, which is really wonderful and really outlines what Musgrave did so well, which is in an era where scientific curiosity dominated, he brought back the idea that we are also motivated by the search for a good society. And I think, of course, that's right. And this Musgrave quote is fantastic. I confess that I think the undercurrent of this talk in some ways is that perhaps we've overlearned the lesson of Musgrave, which is in our quest to advance what might be an individual's motivation of what a good society might be, we may be neglecting, as in debates on income inequality and other debates, what is really scientific curiosity. So let me just dive right into these myths and mysteries and take you through them. And I'll do each one individually, but I just wanted to present them all together here. So there are really 4 myths and 3 mysteries. The first myth, and the most dominant one, is that the CIT is fundamentally broken. That's been a narrative for as long as I can remember, for 3 decades. I want to try to challenge that. And of course, it's never been stronger than today. Why? Because of myth number 2, which is that the digitization of the economy is an existential threat to the corporate income tax. And myth number 3, which is that transfer pricing is also an existential threat to the corporate income tax. And then the final myth is that somehow this corporate income tax is an effective tool for redistribution. I think each of these is manifest in multilateral efforts. It's manifest at national levels of the policy debate around the corporate income tax. And I'm going to try to suggest to you that at a minimum, they're overblown, and perhaps more profoundly, I think they're just wrong. In that process, we've neglected these mysteries, which is, I think, a much better agenda for us to be thinking about. So the myths are both, I think, incorrect and leading us astray, but also leading us away from what is truly interesting. First and foremost is that corporate income tax should be framed and should be understood within larger capital taxation questions. And our obsession with what we view as a faltering corporate income tax has, I think, misplaced that. And there are very interesting questions there. Second, the corporate income tax is primarily about identity and not investment, which hopefully will be something that will become more clear as I work through it. And then finally, that actually, if anything, we should be thinking hard about how successful the corporate tax reform, how successful the corporate tax has been over the past 30 years. And in fact, how other parts of the fiscal system are in considerably more strain than I think the corporate income tax is. Okay, so let's just kind of go through those. So the first, I think, is fairly straightforward, which is that for the last 3 decades, we have heard repeatedly about the fatal flaws of the corporate income tax. And most recently, we've heard it, and quite eloquently, from folks, including the Oxford Group, the IMF. I'm only identifying those, but it's everywhere. So the IMF has been clear that it's under unprecedented stress. People who should be paying tax aren't. Tax competition is unaddressed, and difficulties will only increase. The Oxford Group is a little, more sly about this. They say that there is a widespread perception that it's broken, and other people are voicing complaints about it, so we have to address it. But at a minimum, they suggest that it is susceptible to avoidance, extremely complex, expensive to administer, and it is not working under their criteria. Okay, great. So, why is this important? It's important because various reform efforts, which are very significant, are predicated on the CIT being broken. So specifically, there are folks arguing that we should abolish the corporate income tax because it is so broken. We should transform it into a subtraction method value-added tax because it is so broken. No, we should transform it into a regulatory tool to control monopolistic firms in the views of some. Well, it's so broken because there's no multilateral cooperation. So we need lots and lots of multilateral cooperation. It's so broken because We have this digitization happening. We need new instruments, DSTs and diverted profit taxes, because it is so broken. And by the way, we are going to abandon the arm's length principle because, again, it is all so broken. These are very, very significant changes to a corporate income tax, which has in many ways undergirded, and cooperation around it has undergirded 40 to 50 years of the globalization of firms. So the question really is any of this true? And so the first thing and the most important thing to say about this is it is difficult, if not impossible, to find a collection of countries where revenue from the corporate tax is declining, so let alone broken. So one can look at the OECD, one can look at high-income countries, one can look at low-income countries, one can look at middle-income countries. There really is no evidence, nor has there been evidence for the last 30 years, during which time people have been doomsaying about the corporate income tax for the last 30 years. There is really no evidence that it is broken in a substantial way. People put attention on declining rates. But of course, as I'll return to later, declining rates and steady revenue would usually be considered a success. And somehow we've considered all of this a failure. So I'll return to this later, but the first big idea is that it's not clear that anything is wrong here at all. The reason why this is complicated is because the doomsayers are, I think, unfortunately, hastening the eventuality that they purport to regret, which is a way of saying it's actually this doomsaying just causing so many of the problems because it's giving rise to fears that are not underlying in reality. And it's leading to precisely the kind of behavior that actually might harm the corporate income tax. So it is, in fact, eroding broad trust in the corporate income tax because we keep saying that the corporate income tax is broken. It is giving rise to distinctive and incompatible anti-avoidance regimes, which in fact is problematic for the corporate income tax. But that arises out of that fear. Digital services taxes have arisen out of, again, this rhetoric that everything is broken. Abandoning the ALP without reasonable alternatives, again, is arriving because we keep saying it's broken. And of course, unilateral actions that can give rise to double taxation, again. So let me just also advance an alternative hypothesis here. And that alternative hypothesis is, of course, that the US system was broken prior to the TCJA. The combination of a very high statutory rate and relative to the rest of the world and a worldwide regime did in fact give rise to pathologies that were manifest globally. Those actions were highly problematic, but they were also isolated and overblown in the public imagination. None of that means, for example, that the corporate income tax is broken per se as an instrument. And it does not mean that those pathologies that were manifest from US multinational firms around the world will persist past that broken regime and past the reforms of 2017, 2018. In short, this would suggest that we're fighting last year's battle. And that, I think, is highly problematic. Myth number two, the digitization of the economy is an existential threat to the corporate income tax. Now, you can find this pretty much anywhere. I mean, certainly it's coming out of the EU, which is the current corporate income tax rules no longer fit the modern context. It's clearly unsustainable in an increasingly globalized and digitally connected world. We have to change everything. And of course, these are just a few maps about places that have are considering digital services taxes or implemented digital services taxes, because again, digitization is an existential threat to the corporate income tax. It's of course curious that exactly as people have propagated digital services taxes, they have propagated patent boxes, but we'll put that aside just to try to examine the underlying claim. So there doesn't appear to be much evidence that digitization has reduced reported profits from the information industry. That's true in the EU, according to a wide variety of metrics, and it's true in the US. If you look underneath the data from the statistics of income, the information industry, which is presumably where you'd find all this, has performed steadily in the share of aggregate profitability, actual reported profitability, taxes paid, and even within the information industry, there's no evidence that the subsectors that are associated with digitization is leading to lower reported profitability or lower taxes paid. So again, in some sense, this myth is not grounded in reality. Transfer pricing is an existential threat to the corporate income tax. I'm sure you're familiar with this myth as well, which is, again, just to pick on a few folks, IMF saying they've been substantial in many advanced economies, even more so for developing countries, remember myth number one, doesn't appear to show up, at least in the aggregate data. Again, the Oxford group says other people say it is broken, and whatever the overall empirical estimates, tax avoidance remains of critical importance. And we have estimates from folks who are out there saying at least 40% of multinational profits are shifted to tax havens globally. Those are very significant claims, literally numbers of hundreds to 200s of billions of dollars being shifted annually by some estimates. The only problem, of course, with this is that this debate is at a minimum completely unsettled, and there are various very significant measurement issues that would suggest, at least to some of the experts in the area, that these claims are highly exaggerated. So I put up a couple of quotes here, and some of them are from co-authors, but arguably, aside from my affection for them, very thoughtful people on these issues who conclude that estimated magnitudes of BEPS is typically much smaller than that found in earlier studies. It appears that even a complete solution to the problems of BEPS, were one available and implementable, would have little direct impact on government finances. So I think this too is, in the popular imagination, dominant, in increasingly academic debates, dominant, but in fact not necessarily undergirded with much reality. Myth number 4, the CIT is an effective tool for redistribution. So what do I mean by here? So fairness has now become a standard way for talking about the corporate income tax, not just by politicians, but by academics. And reforming the corporate income tax is framed as a way to achieve progressive redistribution. So obviously there are politicians who have framed this in terms of fairness, but now, including the Oxford group, has made fairness a criteria for designing corporate tax. And in fact, they conclude that a tax on business profit is not part of a fair and progressive tax system, or a weak instrument rather, in doing that. So let's examine that claim and see what we can think about it. So first, it's puzzling to think that a tool with such unclear incidence could become so clearly a tool for progressive redistribution. And in fact, the best, most recent work, I'm just citing 3 papers here that are very recent, I think that are all excellent. One by Clemens, one by Owen, and another one on product prices, all indicating that workers bear half, at least a third, of the income tax. And in fact, it falls disproportionately on low-income folks. And the work on product prices would suggest, again, that it bears mostly on lower-priced products and items purchased by lower-income households. So the notion that this is the first place one would look to address progressive appetites and redistributive appetites, which I could sign up for, is really puzzling. And moreover, the idea that something like the DBCFT is more fair than the CIT, given that its incidence is unclear when it has very large exchange rate effects and changes asset holders and depends on the nature of wage contracts, seems unclear. And it's not clear what social welfare function under which one is more fair than the other. At a minimum, it would be nice to kind of think through what that means. So what are the underlying mysteries that are being neglected? So I think the first is that the corporate income tax is part of a larger capital taxation question, which is by emphasizing the brokenness of the corporate income tax, we've neglected how actually the point of a corporate income tax is to understand capital taxation, more generally, which is just a way of saying, fundamentally, one, I think, of the most important reasons for thinking about a corporate income tax is to actually tax capital income at the entity level, because either we have a realization-based system at the individual level, or it's imperfect at the individual level. And that combining entity level and individual level capital taxation is part of the rationale for corporate income taxation. As a consequence of that, talking about the corporate income tax in isolation is unhelpful at a minimum. And then if we can reconnect it to capital income taxation, then we can first off have a meaningful discussion about fairness, but also then address what I think are the more interesting trends that we're not paying nearly enough attention to. For example, the dramatic rise of tax-exempt investors and the rising importance of capital gains and dividends relative to labor income. So Steve Rosenthal has some very provocative work, and I know I'm showing you a lot of data, but it'll all be available in the slides, that tax-exempt investors now dominate equity markets, at least in the United States. I collected some just simple data from SOI, which suggests that the ratio of capital gains and dividends to salary and wages has been increasing dramatically over the last 20 years, suggesting that more and more of the individual income tax is in fact capital income. We have the work of Wojciech and Owen and others kind of looking at the declining role of C corporations, again, making us kind of relocate our inquiry away from the corporate income tax per se, and to this broader question of how do we want to tax capital and capital income. And in particular, the debates that are really important about integration, about the ways in which taxation on capital gains and dividends fit together with the corporate income tax have really, I think, been neglected. So the second mystery that I was just going to identify quickly is just that I think we have overemphasized investment rather than identity in thinking about the corporate income tax, which is just a way of saying, in a world of shorter equipment lives, IT equipment, in a world of expensing, certainly in the United States, and debt financing, we've spent a lot of time thinking about investment. But the real interesting margin in my mind that we've neglected is about identity, which is just a way of saying, how does the corporate income tax change the way we classify labor income, change the way we identify organizational form, change the way corporate structures are done via M&A, change the pattern of governance? That, to me, is the under-examined question of corporate income tax. I just put up here new business starts for the US post-TCJA, where we have a big incentive to change the nature of labor income and conceivably contract out for certain kinds of things. And you see a fairly significant rise, and then a very puzzling set of data during the pandemic about how many new business starts there are, which is just a way of saying the question of how and why we take our labor income and our capital income in different forms and how the corporate income tax influences that, in particular the reforms of TCJA, seems to be the under-examined question, rather than the questions of avoidance, digitization, and the brokenness of the corporate income tax. And then finally, I would just say that, to really flip the script is to say that in many ways, what we should be thinking about and talking about is the success of the corporate income tax. So, in 30 years ago, one would have said that, well, we're going to dramatically reduce rates around the world on the corporate income tax. And at a first approximation, revenues will be stable, if not higher. I think people would have said, wow, that's pretty great. And instead, A, we're bemoaning it, and B, we're not really asking the interesting question to my mind, which is, how did that happen? What can we learn from it? And if anything, perhaps there are other places one would look for understanding what is a weakness in the current fiscal system. So broadly at the OECD level, the rise of consumption taxes and the weakness of the individual income tax is the first order story, not kind of anything to do with the corporate income tax. And in fact, over the last 30 years in the US, we've seen the individual income tax become more dependent on capital gains and dividends, as I mentioned earlier, and in fact show more volatility than we might have expected, much more, in fact, than the underlying corporate income tax. All of this is to say that these myths and mysteries, the idea that the corporate tax is broken, that digitization and transfer pricing are existential threats, and that we should be looking to the corporate income tax to facilitate redistribution, progressive redistribution. And these mysteries about capital taxation, about identity, and about the success of corporate tax reforms would suggest the following, which is the corporate tax is not broken. There were problems. There were manifestations of a problematic US regime, and we're fighting yesterday's battle. Second, repeatedly pronouncing the demise of the corporate income tax doesn't serve anyone terribly well. I think it accelerates unhelpful trends because it becomes a self-fulfilling prophecy, in short. It's founded on questionable readings of the data. And I think, unfortunately, it feeds populist sentiment, which I think is very problematic. And then, of course, the interesting mysteries of the corporate income tax, how it fits into the capital taxation landscape more broadly, how it changes identity, and how it is, in fact, succeeding remarkably well during a time when everyone declared it dead, are obscured by a preoccupation with these myths. So I very much look forward to your thoughts, and I'll make these slides available along with some detailed appendices which have all the underlying data.
Thank you so much, Professor Mihir Desai, with his Richard Musgrave lecture there, Myths and Mysteries of Corporate Income Tax. It's time now for the Q&A part of the evening, which will be moderated by Clemens. Now, this is, again, your chance to ask this evening's guests, Clemens, Victoria, and Mihir, as many questions as you like. I'm sure you have many. We'll try and get through as many of them as we possibly can over the course of the next 30 minutes. So ask away, and it's time now to hand over to Clemens for the Q&A.
Thank you very much, Mihir, for this lecture, which was certainly, I believe, many of us will agree, extremely thought-provoking, because there are so many people trying to work and make progress on international corporate tax reform. And for many of them, your lecture was, should I call it a cold shower or something like that, saying that the real problem is maybe not exactly where we are leading all these reform efforts. Now, I find this extremely fascinating. I have many questions, but I shouldn't monopolize on that. So we have our questions tool, and you are all invited to ask questions. One, I would nevertheless like to start with a question to you, Mihir. You said that tax avoidance isn't really the big thing. And I was just wondering, you said you questioned some of the estimates out there, and I think rightly so probably some of those numbers are too large, but there is this other argument saying, okay, we have these companies like Apple and others who are known really for particular tax avoidance schemes. And that's the argument that there is some distortion of competition between these big companies who, apparently don't pay tax or pay very little and the rest. I was just wondering what you think about that argument. Is that also overblown?
Just to be clear, I hope I didn't say that tax avoidance is not happening. I hope I didn't say that. I'm pretty sure I didn't. And in fact, as Vicky suggested, I've, with partners, come up with estimates of how meaningful tax avoidance and profit shifting by multinational firms is. The question is really whether it is as dominant as commentators would make you believe, and some economists' estimates that are being propagated today, which is literally that hundreds of billions of dollars are in havens and are escaping taxation entirely, and literally hundreds of billions. And so that, I think, is the problem, which is, I think, that notion, and I think their reasons are to believe is not true, and is actually the one that's in the public domain. In fact, the Washington Post, that was the estimate that was quoted as Secretary Yellen has decided that we are in a race to the bottom, that we have to stop. So I think that is what I'm challenging, not that profit shifting occurs. Second, I'm challenging why that profit shifting and those really abusive practices, particularly by US multinational firms, occurred. And my alternative hypothesis that I floated briefly in the slides is that that was a particular pathology and very problematic behavior of a period prior to the TCJA, when in fact you had really distorted incentives for US multinational firms. You had the 35% US rate, you had the worldwide regime, and you had around the world a number of very low rate jurisdictions. Well, sure enough, they did pretty problematic things. Google, Apple, you name them, they all did. And I think that was highly problematic. The question is, well, wait a second. Today, we have a considerably lower US statutory rate. Today, we have a minimum tax functioning via GILTI, and we don't have the incentives we saw during that time. Moreover, the estimates of the taxes paid, I I did some simple things with SOI data on the information industry, don't really indicate that there is some substantial behavioral changes over time, nor is there a substantial evidence that they're not paying taxes. It just does not appear to be true. So I am not suggesting that transfer pricing and tax avoidance is not a problem. I'm suggesting that it should not preoccupy the public imagination in the way that it does today, because it is divorced from the underlying reality and it is connected to a pathological period that was problematic, but we risk fighting last year's battle in that process.
Vicky, are you fighting last year's battles at the IMF, and or is the OECD fighting yesterday's battles? What do you think?
Well, can I just briefly say how terrible I feel about being so ungenerous? But I think in part I respect Vicky and the IMF and the Oxford Group so much. These are people who I respect tremendously. You know, Mick and Alan and Michael are the highest class people in the profession. But I also felt as a consequence I could be a little bit perhaps more provocative than I might have been otherwise.
Well, Mihir, I think my colleagues, when they saw your slides, felt you were provocative, so you succeeded in that. Look, I think in a lot of ways we wouldn't disagree. I think you're absolutely right that a lot of the estimates that are out there with respect to corporate tax avoidance, the methodology used can't really stand up and might be overblown. I think, however, there are huge ranges, so we shouldn't err on the side of the minimum always. And, as we point out frequently, the corporate tax is more important for low-income countries as a relative matter than it is for high-income countries. They have an extremely difficult time developing and enforcing a personal income tax. So, and they also have an extremely difficult time just raising enough revenue. And for them, a bigger portion of their revenue comes from the corporate income tax. And I think it's safe to say, there, as you say, there is a fair amount of tax avoidance. I don't think we or the OECD are necessarily fighting last year's battle or last decade's battle. I think BEPS, the project from the 2015 action items for the base erosion and profit shifting project, were basically loophole closers. They were aimed at being loophole closers. You're right that the U.S. tax system plays a big role in minimizing the corporate taxes that are paid, certainly by some of the biggest multinationals. But the current OECD efforts, complex and controversial as they are, focus on two things. One is how to allocate corporate profits across countries, and that is pretty much an advanced country fight, let's be frank. The OECD's own estimates indicate that there'll be very little net revenue raised from changing those allocations. However, the other part of this project, setting a global minimum tax for corporate income, that is ensuring that corporations pay at least some yet to be determined effective tax rate or rate of tax somewhere yet to be determined is probably pretty important. I know you showed a lot of data about the fact that the corporate revenues, at least if you look at the OECD countries, have remained relatively steady as tax rates have plunged. But I mean, the flip side of that is, say, for example, the European Commission did a very interesting study a couple years ago. Time is hard to tell in the pandemic, but relatively recently, with a counterfactual showing what would have happened if rates hadn't fallen, other things being equal. So one has to ask, does it mean that the system's not broken just because revenue stayed the same when otherwise there's certainly an argument that revenue would have risen a lot? So I think I'd leave you with that. I think there's two sides to the story, Mihir.
Yeah.
I do think your emphasis on ownership is incredibly interesting. That's why I picked out capital ownership neutrality from your your many incredibly interesting works to sort of highlight today. So that definitely an interesting.
And I think, obviously I was provocative and deliberately so in this, in part because I felt that the debate had become one-sided. But I just do want to return to the idea that revenue, which I'm very much emphasizing here, is an important place to look for a dysfunctional system. And declining rates, by themselves, which have been leveling in the last 5 years, are by themselves also not terribly problematic. And the thought experiment of declining rates and steady revenues, even amongst the parties who you are rightly preoccupied with, Vicky, lower income countries, isn't showing up in lower revenue. So it is not that all of these concerns are irrelevant at all. I think the spirit of the talk is the degree of concern, is the speed of action, is the preoccupation with it consistent with the empirical facts? So I probably erred in my presentation in being overly provocative, but it is, I think, in part to be a corrective, or it was meant at least in part to be a corrective.
And also not to take away from that, I actually thought your talk was incredibly interesting. And one of the things that you say that's obviously totally true and super important is the fact that it's the overall taxation of capital income that's the issue, really. That's the issue for inequality. That's the issue for raising revenue, too.
Exactly right.
Corporate tax we've always said, has a role to play in that, in the sense that you can't necessarily get it from the personal income tax. But as Mike Devereaux has pointed out, it's people who pay taxes. So it's either the owners of the capital or the owners of the labor or the consumers, ultimately. The company doesn't really exist, which is why I think the ownership issue is so interesting. So I wouldn't disagree with you there, as I'm saying.
And I think that is, there's this kind of destructive part of the talk, which is, these myths are bad. But the constructive part of the talk was meant to be, look at all the questions that are really interesting and important, and let's reorient attention there, because the capital taxation question is fascinating, right? And with the rise of tax exempts, as one example, what do we make of that? Do we not want all those shareholders to bear any tax because they're tax exempt? If so, what does that mean for the corporate income tax? What should we be thinking about with respect to integration? I mean, those are the questions that I would prefer us to be emphasizing, and I think are really first order given developments in the last 20 to 30 years.
Can we maybe get into that a little more? So you said, okay, it's about, if I understand this correctly, tax-exempt investors like pension funds. So they benefit from these loopholes. But is it also about income shifting in smaller businesses? Because you said, it's actually labor income, and some of that gets shifted. So would you say, is that a big issue, smaller businesses, or other ways of shifting labor income, maybe in executive compensation? Is that a part where the system has
I think those are separable and both interesting. So there is issue, and Owen and others have done great work about labor income and perhaps shifting of income. But there's also just the first order story of the last 40 years in the United States, which is the change in retirement schemes, the growth of tax advantaged opportunities for savings, the demographics that have given rise to more and more assets being held in that form. And it leads to this unexamined question, I think, which is, well, what does it mean to want to have a tax-exempt sector be as large as it is and receiving capital income to such a large degree that it does? And what are the implications for the corporate income tax? Now, one answer is, well, then we need the corporate income tax all the more. Why? Well, because we're not collecting it at the individual level. But well, then what are we trying to do when we create such large tax-exempt entities, and sorry, not entities, but such a large tax-exempt sector that is so dominant in ownership of corporate capital and capital more generally? why then does that mean we should be taxing at the corporate level? That seems to me to be the under-examined question, and a far more fruitful one, which is how should we be rethinking capital taxation? Do we believe those incentives are ones that we really need and should have and are not just windfalls to very wealthy folks? That seems like a more interesting set of questions than the ones about, well, we need to get at rich people through the corporate income tax, which I think is highly problematic.
Let me remind everyone that there is a possibility to ask questions in Slido. I'm not sure I see the questions coming in here. Maybe I can ask the colleagues whether they are passed on to me. So here you can see where you can submit your questions. So as we're waiting for questions to come in, let me maybe raise another.
Sorry, Clemens, I can see a few from Mike Devereaux, which I'd love to address because I respect Mike so much. I see him on the Slido. So Mike has first has raised perhaps what is what might be my misreading of the issue of fairness, and I take it and I should relook at it. I think what the Oxford group does incredibly well is advance an agenda based on the DBCFT. They advance fairness as a criteria for evaluating the CIT, and they state quite clearly, I think, that it fails on that metric or on all their criteria. But I may have overstated the degree to which they make a direct comparison between the DBCFT and the CIT. And Mike, I apologize if that's the case. And then Mike also makes a great point about, well, why are you just preoccupied with revenue? And we should make sweeping claims on that basis, which I take, Mike, and I think that's right. Although, again, what better way, or what better way to think about whether the instrument is succeeding? And in a world where rates have declined and revenue is steady, I wouldn't make it perhaps I overstated it. Is it succeeding? Well, I would love to know more about how those reforms happened around the world. What happened to the base? What happened to profitability? How did that change? And how should we feel about that? But at a first approximation, my instinct is there are many good stories to tell there. Maybe there are some bad stories to tell, but there could also be some good stories to tell there. And perhaps that's what I was trying to get to. Sorry, Clemens, I was just particularly, because I respect Mike so much, I wanted to address those two things.
Yeah, no, of course. Now, there is another question saying, if I understand it correctly, the corporate income tax has been not just a revenue-raising tool, but also a regulatory tool in the past in the US. So how about that? Is that still relevant, or is that a thing of the past?
Yeah, I saw that coming in from Steve, it's Steve Sheffrin, who it's great to see or to engage with in this way. And I think that's right. And in fact, commentators, including Ruben Aviona, have suggested that it is now should be refashioned entirely as a regulatory tool. And in fact, he calls for a very progressive corporate income tax, which would exempt a lot of corporate income below, I can't quite remember the numbers, but several $1 billion to really be a tax on bigness. So that's intriguing. What I guess one would begin with is the most obvious question, which is, why is tax the right locus for regulatory restraint on big actors? When the tax was created, it is true that the folks who originated in the US voiced regulatory reform, amongst others, or regulatory control of bigness. This, of course, was during the progressive era of the early 20th century, as a reason to have the corporate income tax. But today, of course, we have many tools for regulatory control of corporations, most notably antitrust. And those are much better developed than they were at the time of the inception of the corporate income tax, would appear to be better able to understand what the costs and consequence of bigness are, and then to consider remedies to that. So why we would fashion the corporate income tax into a tool to address bigness, which I think is what Steve's question has to do with, and which what a lot of people are thinking about, is not at all clear to me. And of course, in that process, it will lump together many firms that are not monopolistic, but are large, into combinations of other kinds of firms. So I agree it had its historical origins in a similar way, but it's not clear that in today's world we would want it to do as much regulatory work as I think some commentators would like it to do.
So here's a wonderful question by Clémence Tricot, which I'll throw it to you. She says, okay, now if institutions claim the corporate income tax is broken, and it isn't, why do they claim it? So is there a political economy argument behind it, or is it about identity, or is it populism? I think you mentioned populism. So why do people say that?
Well, so I think that's a great question, and I think there is a political economy to this, which we can try to delve into. Although I don't have any conclusive ideas about it. I mean, I think first we are in a populist moment, and of course, in a populist moment, what the collective global audience demands is, the bashing of larger entities and elite entities and corporate entities. And so that is certainly what the public is demanding in a populist moment. And politicians, of course, will cater to that for whatever particular reason. The question is whether academics should be, and whether we are more generally. And I think that's the more problematic part of it. I think the second part is, there is an effort to, people have ideas about changing it into a regulatory tool, for example. And to advance those ideas, we have to advance the brokenness of the current system. All of this would be okay, I guess, if I didn't have this instinct that over the last 70 years of globalization, of which I am a product of and a beneficiary of, and I think many, if not most of us are, and in fact, I think the globe has been underwritten by not just a global trading system, but by a relatively harmonious set of arrangements in corporate taxation, which have facilitated flows of capital around the world in really productive and beneficial ways. And when we start to dismiss that as being broken, we are dismissing much more than just a fiscal instrument. I think we're dismissing an engine of wealth, and something that has been, I know it's not popular to say today, but I think has been pretty positive for the world. So I think the political economy is, you serve populist impulses, you serve a reform agenda, and of course, you have policy entrepreneurs who would like to make the case that something's broken, which, if it were, is fantastic. But if it's not, it's complicated because it diverts attention from these larger things and brings into question what I think have been pretty dramatic drivers of global globalization and global wealth creation that I think have benefited many, many individuals.
Maybe a question related to this, which is about the political economy of the digital tax. So I believe it was Mike Devereaux who said we should call it Willie Sutton tax, because there's a story about the bank robber Willie Sutton, who, when asked why do you rob banks, answered that's where the money is. And the digital companies are where the money is. So is this maybe just a conflict between states, or between Europe and the US, with the US having all these wonderful companies? So does that play a role? Is it the Europeans trying to grab that money, getting over, violating maybe established international tax rules, or would that be unfair?
I don't know. I don't know enough about European motivations to know, but I think it may be a money grab, but I don't know if that's true. That could certainly be part of it. I think it certainly, as we know, things like the DPT, the diverted profits tax, my understanding is the revenue numbers have never been large, but the political payoff from supporting it has been large. And so I think it's more of a political economy story than a real revenue story. And I think the second part of it is more of an antitrust story or a competitiveness, or a protectionist story, which is about large American global digital companies. Just to be clear, I'm not excusing them. I think the Google double Dutch was a remarkably ridiculous and horrible kind of moment. But it's not clear to me that that means the entire system is broken. Again, I think it means that we had a pathological US system that we have since remedied, that I'm not sure that with a guilty in place, we need to worry about in the same way.
Can I maybe ask you, Vicky, what do you think about this theory of that it's just a conflict about revenues? Is that relevant, or would you say it's not a major issue here?
The DST or fixing the corporate tax in general?
No, the DST, the taxing the digital sector story.
The digital services taxes, yeah. I think that there's probably elements of both, but I think that the digital service tax is sometimes, although it's entirely different, it's sometimes seen and talked about as sort of the alternative to Pillar 1 of the OECD G20 project for reallocating some of the taxable profits of these big, let's call it what it is, probably originally focused at least on these big digital companies, American companies, into countries where they arguably do business, i.e. Europe. I think if you look at the numbers for either of those, the current estimates, if you look at the DST estimates, it's sort of what Mihir was saying about the diverted profits tax. There's very little revenue involved. I'm not sure that everybody knew that. I don't know who knew it or who predicted it, but at present, if you look at any recent estimates of countries that have it or may have it, the numbers are very, very small. So I do think that a whole set of unilateral, uncoordinated actions is very likely to pick up on something Mihir said. Unilateral, uncoordinated action is very likely to kind of mess up the system as it's worked. But I would take a little issue with Mihir in saying that just because, suppose we think it's broken, that doesn't mean it can't be fixed. That doesn't mean it has to be thrown out. In fact, if we think it's been increasingly broken over the last 2 decades, I think Mihir's argument would very strongly support fixing it, which is what I think he's saying the U.S. enactment of the so-called guilty minimum tax does in part. And I would argue enactment better of a multilateral global minimum tax would go a long way to helping with. I think some of the things that were cited, I wouldn't differ that a few decades ago, the system may have been working pretty well. But I think your own example of the Google double Dutch, this and that, and the incredible use now of diverting, even if there's not that much revenue at stake, it's pretty clear the fair amount of profits diverted to low-income jurisdictions in the course of complex planning. And that seems to me like just to be a transactions tax as opposed to serving any reasonable allocation of capital or ownership.
Right. I guess the question is whether these problems, which you and I would agree about, which is profit shifting to havens, is a reason to strengthen enforcement, to jawbone firms, I can understand. To redo the entire international tax architecture based on those anecdotes and those complicated and problematic transactions feels, given the limited amount of revenue at play, feels unfortunate. And that, I think, is where I'm kind of at, which is there's a little bit of the tail wagging the dog here of we are redoing the entire international tax architecture now with a call for a global minimum tax, which is interesting. Although we shouldn't, shy away from the complications of doing that, which of course the EU has, because presumably that requires a common base, and that has been hard, and that is a hard thing to get to, and to do that in the EU, you would know better, Clemens, has been complicated, and I'm not sure again why we would do that unless we had a very clear. And I guess this is where it comes down to, which is, what is the diagnosis, right? So the diagnosis is either things are fundamentally broken, we have to redo things, or the diagnosis is things are kind of okay. There was a pretty bad period and we have problems, but it is not broken. Those two goes in two very, very different directions. And I'm on this path that is, and maybe it's just more conservative in a Burkeanian sense, path, which is, I don't know why we would throw away a system which is working roughly well towards much more radical alternatives that are unproven and unclear when we don't have a clear diagnosis.
Can we maybe turn to two reforms, which I believe are very important? So first of all, you talked about it, the 2017 corporate tax reform in the US, and maybe also the income tax reform. And then even more strikingly, what will be maybe the 2022 tax reform in the US. So there are currently plans of the Biden administration to, kind of revert the Trump tax, the 2017 tax reform and increase the corporate income tax to, I believe, 28% and introduce some kind of minimum tax. So maybe if we start, there's also a question about that in the chat with the 2017 reform. So there are people saying it didn't do much for investment. Now, you, Mihir, said, okay, the corporate tax maybe isn't so much about investment, but if you look at it, would you say it was successful? It delivered on what it was expected, or is it a failure?
Well, so let me try to do that in short order. But I think first, it got some things right in the corporate setting, and then it overdid it. Right, so it was a 14-point rate reduction, which is remarkable, 35 to 21. That was probably overdoing it. It kind of moved away from worldwide, but in a way kind of went the other direction by having this GILTI tax. So I think there was progress made on getting the rate more in line with the rest of the world. There was progress made in thinking a little bit more clearly about moving away from the perverse incentives which kept so much cash abroad. And then there were backwards moves, which we, because we got carried away with the rate, did a whole bunch of new instruments, which again have proven very complicated and problematic. GILTI, FDII, and BEAT, the triumvirate of great acronyms that came out of that act, which are interesting but untested and took a long time to develop and remain problematic because they are untested. BEAT being, I think, a good example of that. So, 2 steps forward, 1 step back is the way I would characterize 2017 on the corporate side. On the individual side, quite a few complications and problematic elements, but let's put that aside for now. Other than I will just briefly mention this kind of corporate individual question, which is really important, which is about 199 Cap A and the way you classify labor income. What's going to happen next is currently, as Clemens, you referenced, back to 28. More importantly, because now the details matter more than the top line rate in a world of expensing. So now we're talking about a GILTI rate, which would not be in the low teens, but it would be in the high teens. So it's conceivable, Clemens, we're now in a world where we go back to a setting where being a US corporation is going to be problematic. And we're back into, and what I fear is, we're back into a world where we play inversion games and whack-a-mole games, and the M&A market becomes dominated by international tax considerations, and firms try to leave, which I don't think is terribly productive for anyone. I would like to see something from the Biden administration that was a little bit more realistic and pushing us back towards 23, 24, 25 with a guilty rate that was staying in the low teens. I think that could be terrific. And most problematically, just to go back to the talk, it's all being framed as being progressively redistributive, as being good, which your work and other people's work would suggest is a really problematic framing for those changes.
Vicky, is that kind of a consensus view? What Mihir just sketched, 25% tax rate and guilty, leave it where it is?
Consensus among whom, I guess. I guess offhand, I'd certainly, well, not offhand, in that I'd certainly agree that dropping the rate from 35 to 21 was overshooting at best, to say the least. 25, 28. I mean, bear in mind, this is the federal rate, everybody. So you add, on average, 5% state income tax, corporate income tax rates on top of that. So at the moment, 21 is really more like 25, 26 in the US, 25 certainly. If you go back to 28, you're talking about 33 again. And the corporate income taxes at the state level in the US actually are important. So in that sense, 28 is pretty high. But I don't have an informed view about exactly what the impacts, relatively speaking, would be of going to 25, 24, 28. I'm not certain exactly what I think the impacts would be. But I mean, Mihir's certainly right that a lot of the other factors involved in all this, where you set the guilty rate, whether you keep expensing, what you do with the personal rate on capital income, has a huge bearing on what this will actually do and what it'll actually mean in terms of both revenue and especially both revenue and then on the personal side, personal capital income, as we've been saying, Mihir's been saying throughout this, has a big effect on distributive issues.
I think the other thing I would add, Vicky, sorry, go ahead.
No, go ahead.
I was just going to say the other piece of it, that the detail, the guilty matters, expensing matters. The part that is really remarkable, and maybe I should have included in the mysteries part, is losses. I mean, losses are of first order importance. They've grown pre-COVID in ways that are kind of intriguing. Firms that have losses, that are larger in losses. And, well, of course, post-COVID, you can imagine what the world is going to look like with respect to losses. And TCJA did some interesting things on losses. So I think the action is going to be all in that stuff more than it is going to be in the headline grabbing rate lines, which again goes to the general point I guess I'm trying to make here, which is the corporate income tax has become a political tool, much more than it ever I think has been, and I think to its own detriment.
That is a fascinating discussion, but I take the fact
we managed to get the pixels in
during
all of the right order, but now it's time to make sure that everybody stays on time, Clemens. So I think we have time for one more question, and then we have to close up for this evening.
Okay, so one more question. Let's take a brief look at Slido. Well, I do have a question, and I think it is also related to some of the questions in Slido, which is from a European perspective. I mean, guilty is there, so it seems to be all done. And meanwhile, many European countries are dreaming about the worldwide, the global minimum tax, would like to introduce that at the OECD level. Has the US moved on and with guilty, and is it all over, or will the US not participate, or is it realistic in this Pillar 2 endeavor by the OECD?
So despite this great honor, I will not pretend to be a prognosticator. I have no idea. My sense is that the administration and the secretary have great appetites for this. And I think they're intrigued by it. I think, the European experience on a common base and the relative success of guilty by itself, to me, brings into question what the additional purchase of and is what is provided by a global minimum tax that in the kind of truly multilateral coordinated manner that people are discussing it as, what that would really be. So I think it is, and again, this I guess goes to the point of the talk. I think it's a political discussion more than it is an economic one. I think it's perceived as a politically valuable and exciting thing to do. Whether or not it should be from an economic perspective is where I'm much less clear about.
It's certainly an interesting signal from the US and something that's changed in recent months, and we will see how this works out. So let me thank you at this point. Let me thank both of you for this discussion, for answering all the questions. Let me thank the participants for bringing in those questions. And now, Marcus, I gladly hand over to you.
Thank you very much, Clemens. Before we go, some final thoughts on some of the themes of this evening?
Yes, I mean, as I said, before I started, before Mihir started, before the lecture started, Mihir is someone who gives talks that are not just intellectually stimulating, not just bringing in the latest research, but they are also provocative, entertaining, and thought-provoking. And I think that was a prime example of that style. And I have to say, I really enjoyed it. I really enjoyed this lecture. And I think one of the advantages of the format, of course, we would all like to be together, but one of the advantages of this format is that we have so many people participating, so many researchers in this community, IIPF members and other guests, and I really enjoyed that. So I would like to thank everybody who participated. I would like to thank Mihir, of course, primarily. I would like to thank Victoria for her fantastic laudation. And I would like to thank the entire team behind this, preparing this lecture. I would certainly also like to thank our sponsors. And last, but by no means least, of course, thank you, Marcus, for leading us through this evening. Thank you.
An absolute pleasure. Thank you very much for having me back again, Clemens, even though I still can't manage to get your surname right, but we'll keep inviting me back until I do, and then you can maybe let me go. So thank you from me to all of our guests, to the entire SES-IFO team, and of course, a special word of thanks again to this evening's sponsor, Hannover Re. The next highlight in the SES-IFO calendar is the Area Conference on Global Economy, which is taking place online on the 13th and 14th of May 2021. So make sure that you mark both those dates in your diaries and register for it as soon as possible. Thank you for watching, and wherever you are in the world, stay safe, stay healthy. Thank you so much for watching, and goodbye.